July 5th, 2024. Coming into the day, I thought actually a bull trend day was not very likely. If you look at the daily chart, we had what I'm assuming was a final flag here. We're getting a breakout above it. And you can see yesterday closed above the breakout point. So consecutive bull bars probably going at least a little bit higher. But I thought it would be really important for the bulls if they were able to get one more bull close above the breakout point, and they did today. But I did not think it was all that likely. So actually, my main thought, or one of my thoughts coming into the day, was we might, it was a little bit more likely that we would get a bear close today than a bull close. Obviously, it ended up being a bull trend day, so it was not one of those times. But I thought that was reasonably likely. Another thing that's interesting is usually on a bull trend day that lasts all day, like it did today, you end up getting a couple of open gaps early in the day, and we didn't really have any gaps. We had body gaps here. you know suppose you could say this is a body gap, this is a body gap, but even this overlapped with this breakout point here. So there was a lot. We didn't really have an open gap until the middle late part of the day over here. And at that point, it's too late because the bull trend day has already happened. But I thought it was interesting that we basically had no open gaps, and we ended up getting a bull trend day. That's pretty unusual. Bar one, a bull bar with a strong close. It's a bull reversal bar, and I used yesterday as those Wednesday is reasonable, but you could also just use last Tuesday. The half days and stuff are kind of fuzzy, and this doesn't really count the day in my mind. But anyways, a bull bar closing near its high, a good looking reversal bar, probably going at least a little bit higher, but I'm not sure how much higher. Like I said, we're breaking out above a tight trading range on the daily chart. So a lot of times when you try and get a breakout of a tight trading range, it ends up failing. Consecutive bull bars, bars one and two. So we're always in long consecutive bull bars above the moving average, and they're both closing basically on their highs. So it's good for the bulls. However, you know that there's an 80% chance of a minor reversal at least lasting 5 bars on the open. So do you want to buy here? You can. It doesn't not make sense. But the problem with two, it's kind of the same problem with six, in that if you buy here, you could put a stop here, but there's probably more buyers down here than sellers. So it's really not ideal to buy this close, put a stop down here, get stopped out, and then you buy this close, you get stopped out again. It doesn't make a lot of sense to do that. So it's kind of difficult. Bar three, a doji bar. It's still follow through for the bulls, but it's not really the follow through they wanted. It's a doji bar. If you're a bull, you wanted to see another strong bull bar closing near its high, and instead you got that. And when bulls saw this, a lot of them ended up exiting their longs, causing the big bear bar on bar four. A lot of times the market will repeat patterns, and you can see it did that here, where you have consecutive bull bars, a doji bar, and then a bear surprise where bulls exit. Consecutive bull bars, not quite a doji bar, but close enough, and then a bear surprise where bulls exit. So you can see we had that same thing happen twice. It created an expanding triangle, but it's always interesting when the market repeats patterns. So three, a doji bar. Yes, follow through for the bulls, but this looks like a trading range open to me, since most days are trading range opens. Usually, if you're going to get, if this is going to be a bull trend, you'll probably get a bar like six on bar three. So you'll start getting really strong follow through, and you'll just get a straight rally. Bar four, a big bear bar, but a big tail on the bottom. Bulls hope it's a double bottom with, or a lower low double bottom with bar one, and they're looking for a reversal up. And bears, they want to see this as the start of the bear trend, and one and two, they're hoping was a bull trap on the open, and that we start the reversal down and bulls get trapped in, and they're not able to scale in and make money. We end up triggering the buy above four. It's not a good buy at all. It's not even a reasonable buy, but it is a lower low double bottom. So 4-1 lower low double bottom, and we trigger it on five. It would have been better had bar five remained an inside bar. So it would have been higher probability for the bulls, because then you would be buying above a bull bar closing near its high and an inside bar. So that would have been better, but instead we traded above bar four and triggered. So this became not as good, which is another problem, with bar six, is that in general, when you're buying up here, or when you have a bull trend, it starts with a good signal bar. And obviously this is not a good signal bar. So it makes this a little bit more suspect than it had to be. So 6 consecutive bull bars closing near their highs. But again, the problem with it is the risk is large, right? So if you buy here, put a stop here, you really shouldn't just be sitting through the free fall and then exiting down here. If anything, you should be buying more at that low, because there are most likely buyers below that low. You can see 1, 2, potentially 3, so possibly a wedge. So And if you were watching in real time after we got bar 7, the market kind of hovered around this area and kept, every time it got back up to the bar 6 high, it sold off a little bit and then came back up and then sold off a little bit. That's showing that bulls are starting to exit their longs and they're starting to give up. So we kept bouncing back to that price, and eventually bulls said, you know what, this isn't going to be the bull trend that I wanted it to be. They exited at the market, and that causes the huge sell-off on bar 8. Bar 8, big bear surprise. It's not really what you could say, by the way, bar 7 is a low 2. It's a second reversal, but it's really not all that strong since it's a big doji bar. It's a possible high of the day, but you're hoping for something like this where you got on bar 8 and then follow through. So really, it's better, better not to sell bar 7. I think it's a lot better to just wait and see what happens, because if it's going to be a big bear trend, you'll have a lot more chances to enter. Bar 8, follow through for the bears. It's closing below the moving average, which is good for the bears, but huge risk. So selling down here, probably not ideal because you're risking so many points. You need really good follow through if you're going to take the sell, and instead you get bad follow through on bar 9. You see bar 9, bears probably exit. It's pretty hard to buy above bar 9 because of the giant tail that it has. It's kind of similar to bar 7, where the setup is reasonable. The context, it's a wedge, and the bottom of an expanding triangle open. We've had 4 good bull bars so far today, so odds are we're probably going at least a little bit higher. Yeah, the bears have a surprise on 4 and a big surprise on 8, but nothing's really getting any follow through for the bears. The bulls at least are getting consecutive bull bars, and they're closing near their highs too, which is good. But the surprises for the bears are definitely disappointing. So do you want to buy above 9? I probably wouldn't. Again, it's a wedge. You can just wait for follow through 10, which is a better buy, but I think it's kind of similar. This is potentially the high of the day. This is potentially the low of the day. One of those will probably be right. So it's not, I don't think, unreasonable to be long or short. I'd rather be long, but it's not super unreasonable, I guess, to be long or short, betting we've seen the high or the low of the day, depending if you're a bull or the bear. 10, follow through for the bulls. So we have consecutive bull bars closing near their highs. It could be, it's different than these because these, this is on the open and you get a lot of reversal in the open. I just personally wouldn't trade the first couple bars of the day. And up here, it's potentially a second leg up, potentially the top of a trading range. And here, you're still buying towards the middle of the trading range with big risk. And I still have the same problem with putting a stop down here that I had with putting a stop down here and putting a stop below 1, and that there are probably more buyers below there than sellers. So it does make sense to trade small and use a wider stop. And, depending how the price action looks, if we fall below 9, you could buy more. But it's really hard to buy above 10 and be willing to scale in lower. So, but anyways, 10 consecutive bull bars. I would say we're probably always in long. We've had, of the 10 bars so far today, 9 of them, I guess bar 9 closed at the moving average, but it's close enough that I'll call it above the moving average. Of the 10 bars we have so far today, 9 of them are closing above the moving average. So that's a really strong sign for the bulls that we're probably going higher, and it probably decreases the chances of bears being willing to sell, and it decreases the chances of bar 7 being the high of the day. So at the close of bar 10, definitely always in long consecutive bull bars, I'd rather buy. 11, essentially a doji bar. You can see we traded back up to the bar 7 low, and then started to sell off. It's a good bar for the bulls. It's 3 straight bull bars, but again, this looks like slowing momentum. So one of two things is either going to happen. Either the momentum is going to continue slowing like it did on 12, and then we're going to get some sort of pullback in the second leg up from 9, 10, 11, 12. Or, you'll get some sort of like burst to the upside. We kind of got it, but we did get a pullback. So imagine if you got rid of bars 13 and 14, and then you got 10, 11, 12, and then a burst up on 15. That does happen occasionally. Why does that happen? Because we have 4 straight bull bars. So bulls, think about it from the perspective of a limit order trader. Limit order traders are really going to be willing to buy below bar 12 if it trades below it, or below 13 if it trades below it, or even 11, right? Because it's 3 straight bull bars, 4 straight bull bars. So limit order traders are going to be really, really eager to buy if we get down here. We keep pulling back, but we keep not getting below the prior bar. So limit order traders start getting impatient. And eventually, traders recognize what's going on in that limit order traders aren't even able to get filled below bars, and traders will get impatient and just buy the market. And that can cause like a big bounce, like 15 or something in that context. That would be what would cause that bounce. And a lot of those traders are just looking for a scalp or a trade to the upside, not necessarily a swing. I think it's less likely in this scenario. I think after this, we were probably going to get a pullback, which I guess we did on 14. But that's what there's always that potential right here. 12, an inside bar, a bull bar closing near its high. Good for the bulls. It's a high 1, so the bulls see a bull trend into high 1. Bears, they're hoping to get some sort of lower high double top with bar 8, but we keep getting closes above the moving average, and bulls keep buying the moving average, so it's really not as good for the Bears as it could be. 13 follow through for the bulls, so it's the high one follow through for the bulls on 13, but it's not closing much better than the 12 high. The bulls aren't winning this market with big, strong consecutive bull bars, but they're winning with time. We're getting a lot more bull closes than bear closes in general. And over here, we had some decently strong bull closes, and now we have 5 straight bull bars. So when you have 5 straight bull bars, very, very likely we're going to get a second leg sideways to up. And 14 does something interesting. Obviously, 14 trades below 13, right at the moving average. There's going to be buyers below there, very likely. Maybe not directly below, but within a couple of bars, a bar or two. If you look at 14, one of the reasons I think it bounced so quickly one of the reasons where there was so much buying in these tails and in this area is because this is around the midpoint of the day. So what traders are assuming, especially as we get towards bars 13, 14, 15, is that they're assuming that we've seen either the high or the low of the day. So that little gray line is the midpoint of the day. And if you are assuming we have seen either the high or the low of the day by bar 15, 13, 14, 15. And the reason, by the way, you would assume that is because by the time you reach bar 18, there's a 90% chance you've seen either the high or the low of the day. And so if you're buying in here and we trade in bar, 13, 14, and you're buying in here, it's going to take a couple bars to get to the upside to get the breakout. And once we get the breakout, it'll probably be around bar 18. So that means we'll probably have seen the high or low of the day. And at that point, if we're going up, we'll be so close to the high that it's very likely we break out above. Similarly, if you're a bear and you were selling in this area, it's not great at all because you have 5 straight bull bars. So you're going to get a second leg sideways to up. You're probably going to get a chance to sell higher. But those bears might be selling, thinking that if we do get to bar 18, or once we get to bar 18, if we're going to sell off, it'll probably be somewhere down here, and odds are the high of the day will be in. So it's kind of interesting when the market oscillates around the midpoint at this time of day because traders can bet in either direction. I think obviously, bull was better because you have 5 straight bull bars and we're closing everything pretty much above the moving average. So it's a bit more likely that we're going to get a breakout to the upside of the 18 bar range at this point. 15, follow through for the bulls. It's a good looking bull bar closing near its high. It closes above bar 6, which I think is important. The bulls who about to close a 6 and scaled in, they had a chance to get out here, but they would have had to be really quick. But the bulls who about to close a 6 and scaled in, not all of them are dumping out of their longs aggressively. Some of them are continuing to buy. You can see that because we did not sell off aggressively when we got to the high of bar 6. 16, a disappointing doji bar. So it's a low to short below 16, but it's really not very good. I don't think we're going to go much lower. I think this is probably just going to be pretty sideways. Bears are hoping higher high double top with 7 and a failed breakout above the high of the day, but I don't really know if there's that much left to the downside here. Again, I think this is just a doji bar. We've had so many bull bars, but it's possible that 15 is the second leg trap. 17, a doji bar, bad follow through. So 16 doji, 17 doji. Again, to me, this just looks like trading range price action. It's possible we're towards the top of the trading range, but you have to figure that the daily range is going to double at this point in the day. It did to the upside. You can see that's where we hit up here, and that's where the sell-off started. Usually the opening range doubles. So whenever you get in general, the 18 bar range, the first 18 bars, since it's 90% chance you've seen the high or low of the day, some traders might buy above this high, and theoretically you'd put a stop here, but they would probably use a much closer stop, and they would just go for a measured move up. And if you're going for the measured move up of the opening range, you can still do that on trading range days. You could probably just put a stop here and you buy the breakout, and your risk isn't all that big and your reward's pretty good. So your probability might not be all that great, but trying to make 15, 16 points, risking 8, pretty reasonable 2 to 1, and maybe 50% chance of success. So pretty okay to be long on the breakout, I guess would be my point. Anyways, consecutive dojis, 16 and 17, and then a bear bar closing near its low on bar 18. 18 did not close below 17, but it did trigger below it. So a bit disappointing, I think, that it was not able to break out below 17 effectively. And that the traders who sold above bar 14 and scaled in a couple points higher, what are they probably going to do when we get back to that price? They're probably going to start to buy back their shorts. So some of that probably contributed to the buying on bar 19. You can see bar 18 closing near its low, and the bears wanted to drive the market down below the moving average, but we've had really just one close below the moving average so far today. So I don't think selling 18 is a very good idea. There's probably going to be buyers at the moving average, and there was. 19 is a high one buy for the bulls. It's a doji bar. You can take it for a swing. I'm not, I don't think it's like the world's best trade. I think it's, we're more likely to be sideways here. But again, with how many closes we keep getting above the moving average, it's very possible. That we continue to rally. And again, you're probably the daily range is probably gonna double. So it's okay to take that chance buying above 19. But that is personally for me not the kind of trade I would take. I would rather look for follow through. 20, more follow through for the bulls. So we have consecutive bull bars, but basically a doji 19 and follow through 20. Yeah, but not the best looking bar with the tail on the top. And also it failed to break out or close above the high of 16, which is not as good for the bulls as it could be. If you're a bull, you wanted to see bar 20 close above this high, the bar 16 high, and it failed to do so. So that's kind of disappointing. 21, more follow through for the bulls. It's a bull bar closing reasonably above its midpoint, but again, a big tail on the top. So these tails are pretty disappointing for the bulls. However, you have to keep in mind, we're in a really tight channel up from bar 9. And so we're probably going at least a little bit higher. And again, the bears just cannot get anything below the moving average so far today, which is really, really disappointing. A side note, this IOI pattern over here was a final flag, and wedges in general usually correct for about half as many bars as they went on for. And so this was, you can see 22 bars. So starting on bar 31, how long should the correction be? About 11 bars. So it should correct until bar 42. And I think the move up started on 41 with this big bull bar. This, could be some sort of breakout pullback. So again, usually when you get a big move up, just look at how, take half that many bars, and that's roughly how long you should be in a correction for. So 21 follow through, but a big tail on the top. It's not as good as it could be. Again, with the tails 20, tail 21, I'm not as confident as I'd like to be in the bulls. 22, an inside bar, but not able to close near its low. So the bulls who bought can remain long, I think. You can see we were not able to get back to the bar 19 high, which is pretty important. That's, just let me check something. Okay, so we were not even able to test the bar 19 high. So the bears who sold above 19 and scaled in were not able to get out, which is pretty important. But anyways, 22, a bear bar, but a tail. Bears are hoping wedge 1, 2, 3, or something along those lines. But again, nothing is worth selling here after 3 straight bull bars, and it's a really bad looking bear bar. And we've been above the moving average all day. I'd just rather wait. 22, huge tail on the bottom. So again, this is not that good for either side. It's possible we're starting, some sort of two-legged correction to the moving average. It's a bull channel so far, right? So it's not some really huge, you could argue spike here to bar 13 and then channel, but I think the whole thing was kind of just a channel. And in general, in channels, you want to buy reversals up from the moving average, but it's not giving you, good looking entries from the moving average. So I thought this was kind of a difficult, there was some difficult setups on this day. 24, an inside bar. It's a high one buy for the bulls, but it's not really all that great. It's also 3 straight bear bars, 22, 23, 24, and we have not had 3 straight bear bars yet today. So I thought it was possible that we were going to get the start of what would become a trading range. At this point in the day, it could be a bull trend because of how many closes we've had above the moving average, but I still thought, I was still kind of thinking trading range with the big bear surprise on 8. Again, it could be a bear trap on the open, but in general, I thought, you don't usually get 3 straight bear bars in bull trends. Sometimes you do, and it's not like they're strong bear bars, right? So it's a little bit more acceptable. One of them is doji, but in general, just 3 straight bear closes is unusual in a bull trend. 25, a bull bar closing somewhat near its high, trapping the bears who sold above 24. You can see the bears who sold above 24 tried to scale in, and they were never let out. The reasonable thing to do to sell above 3 straight bear bars, but those traders ended up getting trapped, and they were never able to get back out of their trade. And it's not necessarily, it's a gap, yes, but it's not a clear gap. You want gaps with breakout points, not necessarily with individual bars, but we are getting gaps with the individual bars like here and like here, which is also, it's important because it symbolizes trap traders. So bull bar after a pullback on 2025, always in long, potentially a buy the close bar. Again, I think it's hard to buy after 3 straight bear bars, but there's always a problem with every trade. It's not unreasonable to do. You get follow through on 26, but it's disappointing, right? You wanted to see a bull bar. You wanted to see 27 on 26, and instead you got a pause bar. which, the doji bar here, it's still follow through for the bulls, but again, it's not what you want. But if you look at, a lot of the good looking bull bars today, a lot of them are not really getting the follow through that you wanted. Bar 2, bar 6, bar 10 had some follow through, which is for sure. 15, so a lot of times the good looking bull bars aren't end up getting the follow through. 20, and then you get a bull surprise, 27, a bull bar closing near its high. Can you buy 27? Yeah, but it's pretty climactic and we're pretty far from the moving average. So it's not unreasonable to do, but I'm not sure, how many more bull bars we're going to get. I don't think the odds favor a whole bunch more bull bars. So it's a bit difficult to do that. Same thing with 28. 4 straight bull bars, 25, 26, 27, 28. Can you buy above 28, put a stop below, I don't know, 20, 22, and just expect that you're gonna probably make twice or make the same amount as your risk. So can you buy the close 28, the stop down here, and expect it's going to go here? Yeah, probably. But you're going to have to sit through something uncomfortable, which is exactly what happened. And so you have to ask yourself if you're willing to do that. It's important to determine the premise of your trade and how the possibilities for the management of the trade, and if you're comfortable with those possibilities or not. And if you're not, it's probably better not to take the trade. An outside bar, 29. Again, I think we're probably going to start to go sideways pretty soon. We have 4 straight bull bars, 25, 26, 27, 28. And, that's pretty climactic. So I think, we are probably going to end up getting another leg up, obviously, but I do think we're going to start to go a little sideways. I don't know if we got a leg 1, leg 2 today. Leg 1, leg 2, not quite. Got close within 2 points, but we did not quite get there. 31, a bear bar, or no, 30. So 30, an inside bar, a bull bar. Good for the bulls, but not really all that great. I think that it's probably an IOI pattern, or it is an IOI, 28, 29, 30, which is, a potential final flag, especially when you're up this high. So some bears might sell below 30 for a scalp, but it's not, in general, you don't want to sell below a bull bar and a bull trend. It's not really a winning strategy usually. 31, a bear bar closing near its low. So I think the thing you have to, to think about is, will we probably get a second leg sideways to down? Yes, we will, because 31's a good looking bear bar and we just had a final flag. So I'm expecting us to get a second leg sideways to down. However, sideways can mean sideways like it was, and the pullback can be pretty deep. So if you're selling below 31, you're not putting a stop above 29. You're probably putting a stop, like, I don't know, maybe a measured move up of 29, somewhere up here. You're not exiting above 32 or 33. You would need one more bull bar. So how am I going to phrase this? So if you sold below 30 or 31, and your premise was that you were going to get a second leg sideways to down and sell with a wide stop, and you can sell more at the 29 high. You can't sell down here, and you shouldn't sell down here to begin with. But if you do sell down here, you can't exit up here. You have to sell more here, because the bulls, when they get 33, they need one more bull bar closing near its high, 34, in order to force the bears out. Right now, it's uncomfortable for the bears to get 33, yeah, but most traders know they're probably not going to get another big bull bar 34. So it makes sense to sell more above 29, and if 34 ends up being another big bull bar closing near its high, then you just get out. But I don't think you have to get out. I don't think you have to get out at all over above 32, and you definitely should not get out at the 29 high. But anyways, 31, a bear bar closing near its low, probably good enough for a second leg sideways to down. 32, I think of it, I think it's a high 1. It's not really that good. I think there's probably sellers above after 31. So some traders might take it, but I would just rather wait. I think if you're going to buy above 32, you probably need to stop below 23, a wider stop, and being willing to scale in. It's the only way I think that's a reasonably good trade. 33, a big bull bar closing near its high, but it's one of the best looking bars in the trend, and we're 30 bars into the trend, so it's really not as good as, or I guess like 20-ish bars into the trend. But either way, it's not as good as it could be because of that. 34, a bear bar. It's an inside bar, a high 1 for the bulls, but it's not what they wanted. They wanted a bull bar closing near its high on 34, and they didn't get it. So I think that gives bears confidence. It's also a bear bar in the bad high 1, so there are probably going to be sellers above. It seems like we might have started the trading range. And you can see there were sellers above during 35. Reverse it down 36, but not really willing to sell below 35. It's a higher high double top with 29, but it's not very good. And then 37, follow through, but we have a big tail 36 and a tail 37. So I don't know. It's not really worth taking anything. I think we're in a trading range. So now that we're in trading range, what are you looking for, right? So you can see 37, 38 is a high 2. You could argue it's a high 1 because we broke to the new high, or you could argue it's kind of a bigger, higher low, high 2. Either way, if you're buying above 38, you probably still need that stop below 23 or a wider stop of some kind. But what are traders looking for, right? Well, the bulls wanted what they got. They wanted, sideways for a little bit and then a second leg up from their initial move. Bears want some sort of lower high major trend reversal, ideally, or some sort of endless pullback. So we had a pretty tight channel down from 36 to 39. Let's say that, and we got 40, and let's say that 41 looked like, the opposite of what it does, or it looks something like 39. Traders might start to wonder if we're getting an endless pullback because the channel down is pretty tight. Those endless pullbacks, they start off just looking like a pullback, but at a certain point, you end up getting a deep breakout. But again, bears have not done any sort of good job with the moving average so far today, so I don't think that that's all that likely. 39, an outside down bar, closing below the moving average, but probably buyers not too far below. This is not worth selling. It could be a wedge, 1, 2, 3. Could be a second leg trap, 1, pullback 2. So really not worth selling 39. First close below the moving average in literally 30 bars. So bar 9, or if you want to argue 9 close below the moving average, then we got 30 bars above. So not worth selling. Disappointing follow through, pretty expected on 40, and traders probably buying back shorts, causing 41, a bull bar, potentially the start of the second leg up, which it was. An inside bar 42. So bears want some sort of midday reversal. And again, they're hoping to get a lower high here, but I don't think it's all that great. Bulls see it as a high 1 in their new breakout after 41. They're expecting to at least get to here, and they're hoping for that second leg up. Bar 42, so there should be one swing left today. Generally, if you start to go sideways in the middle of the day, you should expect there to be one more swing left in the day. And at this point, there probably is. 43, another inside bar. So we have an II pattern, 42, 43. Probably buyers not too far below, probably sellers not too far above. And then we get an outside bar 44. Again, buyers at the moving average. Disappointing for the bears. 45, an inside bar, so an IOI. Really, again, IOIs. It's breakout mode. That's what's important. So IOI here, it's a buy above 45. Better to wait for a bull bar closing near its high, 46, which you get. You get 46. We've been above the moving average for a long time, and it's a bull bar closing near its high, and we're clearly always in long on a potential bull trend day. Buy the close 46. 47 closes above the moving, or above this high, right, which is really important. 47 had sold off and was not able to close above the 35 high. It would have been a lot less bullish. But the fact that it was able to close up here, I think, is really important for the bulls. There's a tail on the top, which is a bit disappointing. But again, I still think it's a buy the close bar. 48, more follow through for the bulls. Disappointing. Bears are hoping for some sort of higher high major trend reversal to take place, but it just looks like a bull trend at this point. But again, tail 47, tail 48, this is not as good as it could be for the bulls. 49, more follow through for the bulls. So we have another bull bar closing near its high. Again, it's by the close, but it's climactic. It's kind of the same buying the 27, 28 area. We're probably going higher, but there could be an uncomfortable pullback at some point. 50 follow through, consecutive full bars, 49, 50. We're way above the moving average at this point. It's okay to be long, but probably start to get ready to take at least a piece off. And then 51, follow through, but a big tail. You can see traders bought the pullback. But again, this is getting into probably more of a profit taking zone than a buy the close zone. 52, a bear bar, but not very good. It's just a doji bar. You have to exit below? I guess not, but I think most bulls will, which is why a lot of bulls bought the close and they just ended up scalping out when we traded above the bar 52 high. That's one way to trade it if you're long. You get ready to exit below bar 52, and then as bar 53 is racing up, you scalp out and pretend 53 closes on its high. A lot of traders would just buy back their long and resume their always in long position. I think that's actually a good thing to do, especially in trading ranges. Like, I don't know, pretend, you sold, you're amazing, and you sold, the close of bar 7, and it trades all the way down here and you make a ton of money. Probably just take your profit at the new low and say if bar 8 closes on its low below the moving average, then I don't know, maybe you can sell again. This is a terrible example because this is a trading range open. So like over here, pretend you bought this close, right? And you go, okay, it's kind of more of a bull channel. I'm not really sure. So when it reaches this high, what a lot of traders will do is they'll just exit their position, right? So they buy here and they get a pretty quick and painless trade up to this high. And so they just exit their position here. And they're like, okay, well, if this bar, the 12 o'clock bar, I don't have these numbered, but if the 12 o'clock bar is able to close on its high, then I'll just buy back my position. So that's a really easy way to think about getting back into the market if you're in a potential buy the close situation. Again, if 53 had closed on its high, it's probably still not the best trade, but not an unreasonable strategy to use, because a lot of the time 53 is just not going to close on its high. 54, a bear bar closing near its low. Bulls will probably just get out, I think. Bears, you can sell for a quick thing to the moving average, but you're not getting much out of this trade. And you end up getting follow through 55. So we have consecutive bear bars closing near their lows, but we're at the moving average. That's been a problem all day, and your risk is large. So it's really not that good. It's not going to undo the 50 bars of bullishness before it with consecutive bear bars. So it's not sell the close 55. It's probably, if anything, more buy the close. Disappointing follow through 56 because bears are not willing to sell, below consecutive bear bars at the moving average. 57, a bull bar, but again, a tail on the top. So disappointing and big tail on 56. I actually want to, let's look at a lower time frame really quick. Just see what's going on here. You can see the tails, 56, 57, 58. To me, probably some sort of wedge on like a 2-minute chart, I would imagine. Or a really weak looking channel, wedge bull channel or something maybe. I'll try a 1-minute chart. It's not as clear as I wanted it to be. Yeah, so some kind of wedge channel on the 1-minute chart ends up leading, you can see maybe 1, 2, 3, ends up leading to a lower high. So more follow through 58, but shrinking body and really not that good. 54, 55 might be strong enough to lead to a lower high. And the bar 55 close is probably going to get tested, big bear bar closing near its low. So anyone who did sell the close of 55 sold small and was scaling in more above the bar. And, the 50% pullback of those, they were not selling there, and just hoping it collapsed. They know it's probably a trading range. 59, a bear bar, but after 3 bull bars, to me, it just looks like the start of the second leg. The bulls are thinking it's the start of the second leg in a 2-legged correction. The bears, well, they're hoping that we start to collapse, but it's really not all that likely. They're hoping maybe some sort of lower high major trend reversal, but it's a pretty small pattern, so I don't think it's going to happen. 60, more follow through for the bears, but again, it looks like it's going to end up being more sideways. This is right now at the moving average that's been support all day. When we trade below it and get a big reversal up 61. Do you buy above 61? Yeah, it's a good buy. It's a high 2, but you have to think about what you're doing. If you're buying above 61, you're buying kind of towards the middle of the trading range. It's also a wedge, 50, 56, and 61. But I think that there's probably also more buyers below 61. And we might have to trade back down to this high and close this gap. It depends because we have entered a trading range. So I think if you're buying 61, you use a stop and measure move down. And if it trades below, you buy back, you buy more. You don't buy back you don't sell it or you're long down here, you end up buying more. So you have to also expect kind of bad follow through because we just got consecutive bear bars 59, 60. So we might have to test back to the bar 60 close or the bar 60 low, where any bear sold below 60 scaling in is going to make money. So again, it's very likely we're going to bounce back to at least the bar 58 close because 3 straight bull bars. And I think even the bar 53 close is going to be a target. But I don't think, and the high of the day, when you get this bar, we never really got a gap bar, but when you're getting tested the moving averages, I suppose this is the gap bar actually. Something interesting tomorrow to watch. I don't know what tomorrow is going to look like if the gap, but we just started trading below the moving average. So just a lot of times if you get a gap down, this is the gap bar, right? Right here, moving average gap bar. It's like 70% chance in general when you get a gap bar, they're going to need to test back up towards the high. We did get a lot of tests down here, but I think that in general, if we get a gap down here tomorrow, we're probably going to try and bounce somewhere back up in here and then go sideways, I would imagine. But after a bull trend day, 75% chance of 2 hours of sideways to down trading, starting by the end of the second hour, 50% chance of follow through buying on the open after a bull trend day. So I guess I would say that I think if we do get the gap down tomorrow, I would think maybe 60% chance of some sort of follow through buying on the open tomorrow instead of 50. So 61, probably buyers below if we go below. 62 just looks like a third leg down. 54, 55, 59, 60, and now 62. And it's the weakest looking leg of the 3, so probably buyers below. Reversal up 63. Can you buy above 63? Sure. We're getting good looking bull bars. We're probably going higher. it's giving you a better entry price than 61, which I don't always love because you shouldn't be able to wait and pay less for more information. But at the same time, you knew that if you bought above 61, you were probably going to go sideways. 64 follow through for the bulls, but now the risk is big, so this ends up being more of a profit taking area around the bar 58 close. 65 a bear bar, but not worth selling anything. Again, the bears have shown nothing but weakness so far today, so there's really no reason to sell anything. 66, sometimes you do get a short or a long bull selling at a long, you get some sort of sell off at the end of the day if you're lucky, but it's pretty unusual to get something dramatic, and it's better to just wait, I think, for tomorrow. 66, second leg up from 63, 64, outside up bar. Follow through 67, basically closed right around the bar 50, 53 close. So really not as good as it could be. This looks like 2 legs up to me. This is not the area to be buying. This is the area to be taking profits. And then you get disappointment, 68, 69. It's an II. It looks like a final flag. You can see we got a failed breakout of the high initially on 72 and try to get the reversal down, but failed and a reversal up 73. Maybe you can buy above 73. I would just be done with the day. It's too late in the day. I know. Usually, once I see the market start to go sideways, honestly, even around like bar 66, 67, if the market starts to go sideways, I'm just usually done for the day. There's nothing. It's not really worth it. I think there's potential for the buy the close or the sell the close, or buy the close or sell the close finish, I'll stick around. But I didn't think it's really worth sticking around today at this area. So stop order trades. There are good limit order trades today. There's a couple of really good ones. Probably like below 13 is a pretty easy limit order trade, I would imagine. I suppose that was the best one, but buying below bull bars, I'm not so sure about buying below 53 because you're so far away from the moving average, and traders don't like to do that. They like to buy below bull bar 13 near the moving average, not necessarily super far away from the moving average. But stop orders today, 6, I marked it because I thought it was reasonable because it's always in long, maybe by the close, but bar 4 is so big, it probably really wasn't all that good. Bar 10 is reasonable. 19, I suppose, but that's not my trade. By the close, 25, 27, but tough, 27. 46, 47 by the close, and then 49, 50 maybe by the close. But again, really dramatic at that point. Maybe you can sell 54, but I don't know. It seems like focus on buying today rather than selling. 61, you can buy above, but don't exit below 63. If anything, you look to buy more. Or sorry, don't exit below 62. If anything, you look to buy more. 63, you can buy. And then, I personally would just leave this alone, but maybe 73. So we have 3 straight bull bars. We might end up going higher. This, as climactic as it is, it's still a lot of bull bars. So I'm not sure. The question becomes, are we going to get a bull close tomorrow? I think we're going to come back into this area. This looks like a final flag to me. I would be surprised if we just continued straight up, but this, that's the thing about small pullback bull trends is you can say that they should stop. And while if it's true that they should stop, it doesn't mean they have to. On the weekly chart, an outside up bar, good for the bulls, probably going at least a little bit higher. But again, could be climactic. I had one other thing that I thought was interesting today. Sometimes I just look at other stocks. But I thought, today I was looking at this, and I was looking at this kind of pattern over the weekend. And so that's why or not the weekend, the 4th of July. So that's why I brought this up, because I sometimes, we'll look at other stocks, and I thought that this was a type of pattern that was interesting. So when you get a sell climax on the open and a reversal up, you can see bar 4. So sometimes you get early sell climax, reversal up like we did here. But you have to keep in mind when you look at bar 4, what's your premise if you're buying for, right? Your premise is that we've seen the low of the day. So it's reasonable to buy above 4 and just put a stop below and try to go for a move to above bar 1. It's not all that likely that it's going to succeed, but if it works, you can make 56 cents risking 16, 17, 18 cents. So 2.5 times your risk, pretty good risk reward. But the thing you have to keep in mind is after you see 1 through 3, if you buy above 4, we're probably not going to go straight up. Even after you see 5 and 6, we're probably not going to go straight up. So you end up getting this pullback, which you have to expect and kind of sit through on 7 through 13. And I was looking at a day on the Emini from a few years ago. like yesterday, and it had like a very similar pattern: sell climax on the open and reversal up. And it's an aggressive reversal to buy, but it's not. It's still very reasonable. And so I just wanted to, share that if you get a sell climax on the open and a reasonable looking reversal up, it's okay to take the trade, but you have to keep in mind that it's probably not going to just turn into some humongous giant bull trend day. It's probably going to get some sort of deep pullback because this should get a lower high. 1 through 3 is pretty strong. It should get some sort of lower high, like we tried to get on 7. So that should happen. So you do have to expect that. And generally, the other example I was looking at also got a 3 push pullback, wedge pullback 1, pullback 2, pullback 3. So it had the same sort of thing going, and then a bull surprise to the upside. Pretty much, the bull surprise was bigger on that other day, but it's pretty similar thing ended up happening. But yeah,